index released today showed that inflation eased to 3.5% in annual terms in July, down 3.8% from June. Now, overall, the Treasurer seemed pretty pleased with those results.
We'd like inflation to fall further and faster, and we expect it to. What we've seen in this data today is really quite welcome and quite encouraging.
Let's bring in macro business chief economist Leith Van Onsel. And Leith, let's start with the market predictions. It didn't quite fall as economists forecast. What kept it a bit more sticky, do we think?
Yeah, Steve, look, there was a lot of uncertainty amongst economists about today's result, really because we didn't know what the impact of the federal government's energy subsidies would be. So we had market economists predicting anything from 2.7% to 3.9%. So it ended up coming in at 3.5%, which was slightly higher than the median forecast of 3.4%. As it turned out, electricity prices and the CPI fell by 6.4% over the month, and that pretty much drove the result. There was some good news, though. We are seeing broadening disinflationary pressures beyond energy. So, Steve, the number of items in the CPI basket which had annual inflation rates below 2% actually outnumbers the number of items where inflation has grown above the Reserve Bank's target of 3%. So we are seeing some broadening, disinflationary pressures, which I think is, good news.
It's a hard thing to get your head around. I mean, petrol prices in Victoria at the moment are really low, but 3 weeks ago you were paying $2.20, $2.30 a litre. Now you're paying somewhere between $1.06 to $1.80, but petrol's in there, right?
Yeah, that's right, mate. Petrol rents, pretty much. There's a whole bunch of stuff that we pay for. Look, the Reserve Bank tends to look beyond those, really volatile measures. So it looks more at things which is something called underlying inflation, and that also eased as well. So that fell to 3.7% in July from 4% in June. And in fact, the monthly result for the underlying inflation was actually the lowest since July 2021. So we are getting some progress there in inflation. The big problem we've got, Steve, though, is that the thing that's driven the fall in inflation over the last year has actually been tradable goods. So that's basically things that we pull off a shipping container. Inflation there's only been at 1.5%. The sticky part is that services inflation or non-tradable inflation, that's the domestically driven inflation, is still running at 5%. And that's the thing that I think will worry the RBA because that's quite sticky. It looks like we've run our race with tradables. They're not going to fall, below what they're at. So if we are going to bring inflation down, we need this sticky services inflation to fall.
Still no rate cut till next year?
Yeah, no, absolutely not. I think we could rule out rate cuts this year. To see rate cuts, we're going to have to see one or two things. One of them is obviously we're going to have to see inflation fall, much further than it has. Otherwise, we're going to have to see unemployment rise, significantly. And I don't think we'll get either of those things before the end of the year.
Wow. Yeah, no one wants to see that, Leith. I agree with you completely. Thank you very much for that, my friend Leith Van Onselen there on the issue of whether we'll get a rate cut.